Hello, everyone. Do we have participants adding up? And I would like, I hope that you are well, healthy, and managing the current environment and manage to be productive in yet another lockdown. Thank you very much for spending the next hour with us on a conversation about the new emerging trend in startup funding, agile fundraising. And usually the typical scenario for startup fundraising is this go big or go bust funding rounds, when they kind of within the 3 to 6 months, they want to collect all money they need for the next 12 to 18 months. But it puts a tremendous pressure on the founder, and it might not just be viable and feasible for them. So the new approach emerged, where founders are raising capital before and after the round. And according to experts, it is becoming more and more popular. But what is the attitude of investors towards this? And this topic and few other ancillary topics we will discuss on this in the next hour with the top experts and top investors representing different parts of investor community. I would like to thank all companies that supported this event. It's Entrepreneurship Club of the London Business School. It's the top business school, one of the top global business schools. And then Tech Nation is one of the largest tech communities in the UK. And Agile Interactive Studios, they are great and amazing, a very hospitable place to create educational videos. So we are very lucky to have with us tonight people of the real kind of importance on the market, real gravitas on the market. And I would start the introduction starting from the lady, Isabella Ghassemi-Smith. She is the ecosystem manager at SeedLegals. And SeedLegals is a revolutionary legal tech company and the biggest startup funding deals closer in the UK. So they have a lot of data of how this is done in the UK. Manuel Costescu. Manuel is the Chief Executive Officer at Angels Den Funding. Angels Den is one of the top British angel groups, and it's also an online investment platform where angels invest in pre-vetted startups. Vahe Vartanian. He is the founder and the CEO of the Global Family Office community. And this community provides a sort of safe environment for family offices to meet, share ideas, share knowledge, exchange best practices, etc. Jonathan Hollis, he is a industry veteran and true expert with amazing network. He is also a managing partner of Mountside Ventures. Mountside Ventures help their most ambitious entrepreneurs raise their next round of funding from seed to Series B. Konstantin Vinogradov, principal at Runa Capital. Runa Capital is a global venture capital group with a focus on entrepreneurs building large-scale tech-enabled businesses. And the company investments is truly global, and it spans 13 countries in North America and Europe. And my name is Nastasia Savina. I'm a marketing veteran and also a head of marketing boutique called One Step to Market. We help companies go global or land softly in the UK, and I will be moderating this discussion. So the logic, the main idea of the panel and the main logic of our conversation. The idea of the panel occurred to me when we have been talking with Isabella some time ago, like a few months ago, yeah? When you sort of enlightened me that this new approach to startup funding actually exists and is gaining popularity. And according to SeedLegals data presented last year, this trend was already rather prominent. So do you have any fresher evidence that, and what's going on in this strange year? Has this trend gained more popularity or not? Isabella?
Yeah, I think so. With this, it's easiest to start at the beginning, and let's take the beginning as February, when a lot of founders had rounds open And suddenly, you know, right before they were closing their shareholders agreements, you had investors getting in touch saying, I'm really sorry, I've got to divert funds to my existing portfolio, or look, I need to hold off, we need to wait a few months. And the problem with there is that founders always cut it really thin, and they probably about 3 months runway left. And then 3 months passed and they were like, well, we don't have a runway. And the moment you kind of go cash flow negative, you're done. And so a lot of these founders were struck with this issue of either having to go through a down round, which, you know, has huge ramifications in the future, or alternatively, you know, going bust. And despite having people on furlough and, you know, despite every other kind of burn rate cost they try to make, there was this issue. And the thing that accompanied all of that was this rise of agile funding. So if anybody who doesn't know what that is, it basically means not just doing one big funding round, giving loads of equity away every 12 to 18 months. It's more like raising gradually smaller amounts, giving away small amounts of equity. And so, you know, in this position where investors wanted to support the startups that they had equity in, and startups wanted to have flexibility, we entered this world of agile funding. And what we have seen over the past now 6 months, and we just had our monthly kind of Q3 meeting, was that the uptake of particularly advanced subscription agreements to raise investment has been huge. We have people raising 1.6 million without really going through a round. And it has given startups that flexibility to meet investors, go, look, are you willing to invest, close that deal, and hopefully, you know, close that round later down the line, just by the fact they didn't go cash flow negative. So I would love to say I have slides. I feel like we've been a bit too busy to produce the data, but just on a day-to-day interaction with all the founders, you know, now of the 16,000 founders we work with, about 70% of them have kind of agile funding provisions in their documents, which wasn't the case last year. So yeah, massive uptake because of the nature of the environment.
What kind of valuation do they expect when they're doing this agile funding? Particularly, you know, as far as I'm concerned, there are two forms of it, yeah? The one which, when they're raising before the round, and the one after the round. So how does it work?
Yeah, I'll keep it brief because I feel like some people get a bit bored of it, and I'm sure the gentlemen on this call will disagree. But so the way it works, especially when you're raising ahead of a round, right? You're telling an investor, give me money. I don't have a valuation, but it doesn't really work that way. The way it works is you have a minimum valuation where if everything goes wrong, basically the investor will be taking control of your company, and you have a maximal valuation whereby if you surpass a certain valuation, their equity will convert, you know, at a maximum kind of price. But what it means is that you're going to be willing to kind of give that flexibility to the investor and to the founders, because that's kind of the cash that's keeping you going. And then the second reason that it makes the valuation actually more accurate, in our opinion, is because before founders actually raise that cash, they've not really been using much cash. And so their valuations are kind of based on nothing, right? So the ability of founders to get some cash, spend some cash, see the results of that cash mean that when they go to investors to close their round to show a valuation, it's a little bit more accurate because there are some numbers behind what they're saying, as opposed to before you're like, hey, give me like 100 grand. I've never really spent more than 5. That's what my valuation is based on. Whereas the second part of like topping up your round after you've closed it is really different, because at that point you've raised money, you have a valuation. Investors can only really come on at that valuation, or arguably at a much higher valuation if they really want to be part of the round. So you're in a much stronger position in the second case.
Mm-hmm. Do they overlap, you know, for the next round?
I mean, see, that's the question though. It's the case of like, did you ever close your round really? I think for me, the definition of a round is when your valuation massively changes. And until that happens, I don't think so. Like within that whole process, there's a pretty good estimate of what the valuation will be. And then in the next round, you're kind of hoping for it to be 4x or 3x to kind of 5x of what it was before. And until that happens, you're pretty much within the same round.
Okay.
Yeah.
Okay, thank you. And Jonathan, I asked you to be the founder's advocate. Why do founders like it so much? Why do founders prefer this way?
Sure. I think from what Isabella mentioned, I think it's hard to argue against, if a founder's about to, essentially go bust, and it's between agile fundraising or going bust, it's pretty clear which one they should choose. And I think we see it in terms of the companies that we're working with, it's one of the many options out there. It absolutely shouldn't be the number one options relevant for all founders, but it's definitely a really solid option for some. And I think what's really important is the two big factors that we see. The first one is what type of funding they're getting. So if they're raising angel funding, or if they're raising institutional funding, and I think the two are very significant as to how the agile fundraising should work. And then of course the second is also the speed of growth for the company. Because if the company isn't doing very well and it's pushing the fundraising down the line, you don't want it to become a bit like a ratchet whereby they've got to meet certain revenue thresholds or certain thresholds to be able to then raise subsequently later on. And so I think there's an element of understanding where they are in their journey in terms of whether they're angels and VC, and also whether they can meet their objectives. And obviously a lot of founders like it because it's, in a way, they're able to close the round quicker, as Isabella mentioned. But also, it's also important to understand that the longer the round is open, sometimes the more hassle and the more continued focus they need to have actually on the round. And even though founders might raise every 12 to 15 months, actually having a round closed is both a psychological relief, because often fundraising can take 3 to 6 months and even sometimes higher, and also simply a way of putting a mark from a valuation perspective. So there's a number of different factors. And then it's also quite interesting to look at it from the LP's perspective. So VCs essentially raise money from LPs, they raise money from family offices and organizations. And often they quite want to see, we talked a bit about this earlier on, the reporting of the round closed so they can better understand how their portfolio are doing. And so often there's also an element of push to the VCs to close the round because that's required from their own investors. And I'm sure Konstantin will touch a bit on that as well.
But is this, I was always interested, is it more psychologically difficult for founders to keep on looking for money all the time, not just, focus on fundraising, for 3 to 6 months and then just forget about it for the next 12 to 18. But if they go for agile fundraising, that it means that they need to fundraise all the time and focus their, all the efforts on fundraising all the time.
Which is why I think it works well for companies that are doing well. For companies that are growing 20%, 30% a month, they're more likely to be able to bring on further investors. But it's a bit like if you take tranche funding as an example. A founder, typically, the majority of founders aren't fans of tranche funding, whereby an investor says, I'll put in £3 million and I'll put in, first of all, 1.5 mil, and I'll give you the second 1.5 mil if you hit these metrics, if you hit these revenue metrics, if you hit some of these user growth metrics. And that psychologically is sometimes quite damaging because there's the stress of hitting it, then the stress of renegotiating the terms if you don't hit it. So if agile fundraising can work well, if it doesn't get positioned as one of those things they have to worry about further in the future.
Okay. But the companies that are doing well, they had no problems raising funds anyway.
Yes and no. I think from a VC perspective, I think it depends who you speak to. Investors will always tell you the best companies always get funded. But if you speak to the entrepreneurs, and I'm sure we've got a lot actually, on this webinar, many of them see themselves as some of the best performing companies. And I can assure you that they don't tell you that they find it straightforward to fundraise. So I think it's all to do with your metrics. If your metrics are upwards looking and your trajectory is good, I think agile fundraising can be a good option for you, especially if you're raising an angel round and you have to herd a whole bunch of cats. I'm sure Manuel will talk a bit about the angel side of difficulty of getting 50 people to agree on one thing, right? But if you're raising, if your metrics are good, then it's a really nice option for you. Specifically, as Isabella mentioned, that if it's a case of choosing between not having any cash and having any cash now, then clearly you can close your round early. The other disadvantage is a little bit of how long you leave it open. And often, you know, that takes a lot of time. Angels can be quite slow. And we worked with a couple of companies in the past where they've closed the institutional round. So they've got their lead investor to come in. The lead VC is committed, but they've left the round open so that angels can actually benefit from also jumping in on the round. And again, that causes its own complications.
Mm-hmm.
So overall, I think the message is it's positive for founders who are growing quickly. The ones who are struggling, it's difficult for them to raise later on. And I would advise them to raise as much as they can first, execute, and then raise the second round later on.
Okay. But you see the second part of the coin as well. You, since you're working with investors all the time, can you just give us an idea? What's your opinion? How do investors see it? This the whole process?
So investors see it a little bit like they see the convertible loan notes, or a little bit like anything that delays valuation. In our experience, a lot of investors are not as big as fan. I'll give you an example. If an investor comes in and gets a 20 or 30% haircut and a discount on the next valuation, the next investor clearly is giving away part of the equity to the one before. And so there's an element, if you keep a round open, or if you're getting a convertible loan or other instrument, your next investor coming in suffers a little bit on the equity than the first one. So it mirrors a little bit that aspect. And then, of course, the reporting element is a lot trickier, because most investors need to show that they invest in 10 to 12 companies or 15 companies and say, this is what the round is. And then they want to show the valuation increase. And the biggest example of that is, if I'm a VC and I'm raising my fund and I've got my limited partners who are the corporates investing into my fund, I absolutely want to show that in a 3-year period, I invested here and now the companies on paper are here. With an agile fundraising, it's very hard, and I'm sure you can tweak the numbers a little bit, but it's very hard to show that upward growth.
Mm-hmm. Okay, but what about the next question would be probably to Manuel. You showed the view of VCs, and I'm sure that Konstantin will have to add something to this. But what about angels? Do angels see this differently? Do they see the benefit of doing this? As individual investors who kind of could use the opportunity to jump on somebody's train, is there any benefit to them?
Well, yes, we need to think of angels in with two hats on, right? Angels are investors, but they're also extremely passionate partners to the entrepreneur, right? They're not just hands-off investors. So while they, on the positive side, they clearly appreciate the flexibility that now the person that they have tied themselves to the hip has the ability to raise smaller amounts, to be more flexible, to be more agile, as the word says it, right? But the problem can rise from the following thing. As an angel, you also know what kind of milestones you need to go through as an entrepreneur. You know that this company, if you give them 30K, it's good. They can bridge another month, or but they cannot bridge the 6 months of runway that they need in order to get to the next really big step. You don't want to invest in a company just to keep it as a going concern. You want to invest in a company because it will be growing in increments that are a little bit longer than a few weeks, a few months. Maybe it's a year. So traditionally, a fundraise that was looking to guarantee the founder 12 months, 18 months out, is preferred by many angels. The corollary of that is, somebody who raises and says, no, but I'm raising for 2 months, 3 months, and then I'm going to come back to you, and so on. So again, I agree that in a situation in which the company is growing well, then as an angel, you can look at it almost as a working capital, not loan, but working capital equity, if you want, right? And you fund, and money comes back in, and it gets recirculated. But if the valuation starts suffering up and down, and people start questioning whether they are getting diluted from these small patches that are added to the balance sheet of the company, that's when angels become a little bit more antsy. So again, it's a mixed story. On the positive side, they prefer obviously that a company have access to capital in order to be able to bridge a certain period or of adversity, but at the same time they want to ensure that they are not in a situation in which they cannot meet the big milestones. And the second point is they need to also ensure that the entrepreneur is not in a continuous fundraising mode, because if your modus operandi morphs into something where you are always looking for investments, always talking to investors, which again, yes, you do, but if this becomes the only thing you do and you're barely taking care of the activities of the main core activities, that's a problem. And while I'm not saying that this is the rule, there might be certain entrepreneurs who get a kick out of it, right? And they're very good at IR, and they deal very well with investors, and they are in a perpetual fundraising mode in small increments rather than focus all the effort and then focus on the operations of the company.
And do you, in your kind of everyday life, see that it becomes more and more popular approach, or more and more frequent situation when people are raising before or after the round, or not?
Well, I think that it certainly is. It muddies a little bit the old waters where the funding round was very clearly established. It had a beginning, it had an end. It was very compact and hermetic. So now we see many people who say, oh, we had some money from before, we raised a little bit before, now we're starting around, but let's leave it open for a little bit longer so that this guy can come in. So it does create a certain fungibility of the fundraise, which again, it gives you the flexibility. And if the two options are death or flexibility with a bit of confusion, then clearly the latter. But I can imagine how an LP who would come in would start asking questions, and then probably a variation letter that shows that, well, I need to give 10% discount on the equity to this guy and 20 to this guy because he's from the previous round. It becomes untenable, right? So it becomes really difficult, as somebody said, to herd 20 angels around the same company when there are so many differences. This is why when it comes down to discounts on various valuations and so on, that can become quite tricky, right? So and we have on our platform haven't seen too much of these special deals and discounts on every single investor who came in before, which probably is good, because there's a certain streamlining that is required in order for the deal to take place. Otherwise, it becomes people just shy away. People just start disengaging.
Okay. And do you see that of the particular scenarios or cases for angels and for founders where this situation is more beneficial rather than damaging? You mentioned the good company and the efficient company where this is really, really helpful, and kind of non-efficient company which is not helpful. But are there any kind of cases, any other particulars where this approach is more damaging than not, or more beneficial than not, than the typical one?
Well, again, I think if a company, so I agree, if a company is growing, right, and it shows a clear growth trajectory, and you can almost see these interventions as bridges between more consolidated fundraising efforts that have a much more structure to them, right? And they bring, let's say, they would bring in institutional investors, and let's say you see much clearer the various rounds parsed across, at yearly intervals. Then people show milestones that are being met and the company being growing. Then in essence, this creates a bit of a linearity in what would have otherwise been a step function, right? My valuation is now 500. Then it's going to grow to 1.5. Then it's going to grow to 5. You see, there's nothing magic about this step. And what happens in between? Well, what happens is that in principle, you should use the money and use it judiciously, grow the company threefold, and then you raise it 1.5. But sometimes it doesn't work like that, right? So sometimes you do need these intermediary steps. So if if an agile round becomes an intermediary step, it's fine. But if what it does is it becomes a replacement for a down round, and then again it's an up round, and then again a down round, then I think yes, also for accounting reasons, it becomes difficult for anybody who is an investor, but also for the I guess the sanity of the angels who are going to say, well, I don't even know whether I get diluted or not diluted depending on what's happening, right? So that constant dilution versus growth of your equity share probably also gets some people less comfortable.
Confused. Yeah. Okay.